the footnotes give a detailed description of the practices and the reporting policies of the company's accounting methods, along with the disclosure of additional information that can't be shown in the statements themselves. So significant accounting policies you need to check about. First is basis of accounting, use of estimates, revenue recognition about sale of goods, interest and dividend, then fixed assets and intangible assets. Then we need to check depreciation and amortization policies, changes in accounting policies, foreign operations, and EPS, earning per share, then employee stock options, and inventories and investments. So we need to check the significant accounting policies about these variables. Okay. Now you'll ask me how to read footnotes. Okay, what to look for? The first thing is to look at the company's accounting method and how it compares to the generally accepted accounting principles and industry standards. Okay, I repeat, the first thing is to look at the company's accounting method and how it compares to the generally accepted accounting principles and industry standards. If the company is using a policy that differs from others in the industry, or one that seems far too aggressive, it could be a sign that the company may be trying to manipulate its financial statements to cover up an undesirable event or give the perception of better performance. So if you see any policy that is that differs from generally accepted accounting principles, differs from industry, and seems far too aggressive, then it could be a sign that you need to check. Okay. The second item of importance that should be examined is any changes that have been made in an account from one period to the next and the effect it will have on the bottom line financial statements. I repeat, the second item of importance that should be examined in is any changes that have been made in an account from one period to the next and the effect it will have on the bottom line financial statements. So these are two things. First is whether if the policy is aggressive and it differs from industry and looks far too aggressive. Second, you need to see from the accounting period if there are any changes in accounting. Okay. Now we'll move to notes to accounts. Okay, notes to accounts contain explanation about changes in accounting policies that we have already discussed. Then provisions, deferred tax assets or liabilities, EPS or operating leases, ESOPs or managerial remuneration, licensed and installed capacities of production, details of opening stock, turnover and closing stock, details about raw material consumed, any foreign currency transactions, and any hedging or any risks related to that. Then related party disclosure, any transaction about related party disclosure. Segment reporting, if a company like HLL, Hindustan Lever has different segments, then segment reporting. And last is contingent liabilities. Look for contingent liabilities, like any case is pending against the company in the court, and any liabilities or contingent liabilities payable to any firm or people, in that case look at contingent liabilities. Then it will have a very bad impact on financial statements. All right, so this was about in this chapter we covered how to analyze cash flow and how to read footnotes. In next chapter we will cover or will focus on director's report and management discussion and analysis and shareholding pattern.